It will trade back down there. But if it does, I'll buy in there. I'll take a buy in that. Okay. But from an algorithmic standpoint, it's better for it to stay open because it will act as a measuring gap or a breakaway gap. And you learn more about that as well. Okay. So around the 50% grade, it consolidates. You can clearly see that. And then we have another expansion. What are we seeing here? Another imbalance. These will not want to fill. Just like this one down here, we have one here. It's close to the 50% grade. They will act as breakaway gaps. In other words, it's signifying strength on the upside. You want to see these remain open. And again, I'm going to counsel you to think about how many times you've heard me in my commentary say it would be better if they left it open. And then they many times stay like that. And they'll obviously fill at a later time, but not before it trades to where we think it's going to go. You see that? So think, what I'm showing you right now already isn't anywhere in books. It's not in any books on gaps. It's not anywhere in the idea that guy created in 2012, the quarters theory. Okay? This is not quarters theory. I'm giving you highly specific things here that are algorithmic that repeat because it's based on the delivery of price. Period. Okay? These things tend to repeat if you are accurate with your analysis projecting a forecasted run like that. That's why I'm saying it's going to take you experience to get there. And that's why I lend my experience in my commentaries. So every time I point to something, if I think, okay, this is where the market's most likely to draw to, these are the types of things you're supposed to be doing. I'm not going to do this for you. Now, if you go back and watch the videos, all these things will start matching up and you'll see why I'm saying certain things and why I'm not saying things about other order blocks. Because I get a lot of questions about, well, why didn't it go down here? I was waiting for it to trade back down here because look, ICT, it has 2 down closed candles. That's a consecutive down closed candle in an 8-hour chart if we were looking at, because this is a 4-hour time frame. And we have an imbalance here. So I was expecting it to trade back down there, and that would be a high probability order block to buy. And I'm frustrated because it doesn't go down there. Your understanding is increasing now with this lesson. Now imagine your first month here and your first week in this mentorship, and I hit you with a lesson like this one. You're going to be like, what in the world are you talking about? This is contrived. It's all made up. This is hindsight trickery. You're conning us, Michael. But you're looking at price action that we were looking at before it happened. And I'm also referring to points in your core content that, like I said, over time, I'll pull on that information that you've learned and hopefully have taken notes, and you'll start seeing how my mind sees these things, and I pull on them for reference. So if the logic is true, it will repeat. If it's repeating and it's true, then my analysis should be strong. My analysis is strong. All these things I lean on. They're not found in books. There's no algorithmic book out there that teaches this stuff. I promise you, it does not teach it. And if you want to spend all the money out there chasing all that stuff, go right ahead and you'll regret having done so. But just remember, I warned you. It's not out there. This stuff I'm revealing for the first time right here. In this mentorship, this is the first time I've ever divulged any of it. The 50% level of a price grade from an unrealized price run or price swing, this is an area where consolidation can occur. We talked about in previous lessons recently about how some of you were concerned about when can I anticipate consolidation. Well, here's where it usually takes place, around equilibrium. It could spend time in here and then make a false run and then go down below a short-term low. That's something that can also happen. Okay, it can create a breaker forming and then come back down to that breaker later on and use that as a buying opportunity. But we have another order block here. It trades down into it. Are we anticipating it running down into this area here? No, because we're grading the price swing. These areas is where the market's going to refer to and reference its delivery. And then the imbalances in every one of these order blocks are within a smaller price range. And you can study all of this on a 1 and 5 minute chart, and it can be an amazing study there as well. I'll leave that for your homework and let you find your own things there. But the market does not need to trade back down here or here into this imbalance. Once we get to the 75% grade, it runs almost to the mean threshold of the bearish order block, which is this level here. But it comes back down and does what? It runs into the order block here. All these down closed candles, it trades into that and runs sell side liquidity out. Some of the instances that you're going to see, there is not usually a stop run around that 75% grade. Usually it's just a real quick run to the target. If it does run the stops, then the next price leg that's going, you need to stay with that. And if you're in a trade like this, you would aggressively trail your stop loss, because it's done a stop run here. And if it does fail to get to your target, once it returns, then it will probably seek out areas like this, because we've taken two targets. We have the bearish order block low here, which is a premium array, mean threshold of the bearish order block on a daily chart, which is here. And look at the bodies of the candles respecting that. Yeah, we get a little bit of a spike through it here and a couple little wicks through there. But overall, look at the volume. You don't think that that's being controlled, folks? It's absolute evidence of being controlled. This is just manipulation reaching for the best case exits. That's broker based. But this is the bulk of the volume. That is coming directly piped in from the central bank. It's absolutely controlled. Also, we're running above an old high here. So it's another area of distribution where they're going to do offset distribution of accumulated longs in here, 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 and here. And what I just said, again, if you're not that far in the mentorship, trust me, it's covered. It's not entirely exposed and taught yet, but I introduce more concepts around it. But I'm pulling these things together. This is why I tell you all that there's no way for me to take almost 3 decades of information and understanding and can just press it into a couple videos and you think you can watch that and walk away and know what you're doing. It's absolutely impossible. Like, I wish I could do it and then my job's done. Then I can go about my normal daily life and everything's easy. But it's just a lot of unpacking to do, and you can see how all this stuff works beautifully together. You can forecast buying opportunities around the 50, the 25, and the 75. You're forecasting that. Before it ever gets there, you can anticipate that there's going to be a buying opportunity. And I'm giving you rules about where and what grade offers what type of condition. 50% is usually consolidation. If there's an imbalance below it, it tends to stay open. That's the best case scenario. It can fill it, but if it does go down there, you buy it. 75 tends not to have a sell stop run. It tends to consolidate, create a optimal trade entry type event, and then run to the target. So I could have given you an opportunity where we're giving you the best case scenario using the mean threshold, but I gave you this as a draw on liquidity. Now watch what happens when it creates this point here and then rallies. You're trailing your stop loss all the way through here. Once it gets above the mean threshold, your stop loss is anywhere in this area here. So what are you looking for then? You want to see it run higher. But if it starts to break down, you're going to get stopped out. Why? Because if it's going to break down in here, it's going to attack the sell side liquidity resting below here. The market breaks down, takes the sell side liquidity out right there. So if your stop loss is trailed here, you gave up all of this paper profit that hasn't been, it's basically unrealized profit. So if you have a live trade on, which you're not supposed to have while you're in mentorship, but if you have a trade on in demo, these profits will be eroded and then they'll attack here. So it's taking you out at a less favorable position exit than that of being stopped out here, because you're trailing it. Once it gets above this high here and we're at the mean threshold of that daily bearish order block, you have to be cognizant of that and thinking, okay, as much as I want this rejection block to be traded to, I might not be right. So you want to manage your stop appropriately with that in mind, because that could be the catalyst for you getting stopped out and giving up all of this here, which is basically a full 100 pip price range. But once it takes out this level here, watch this unrealized rejection block on this high here, we come back down into the 75% grade of the price swing. Has that objective been met yet? No. So we're trading back down below this low right there. Think about the rules I just gave you. 75% grade generally sees no run on stops. But if it does run the stops, you can use that as a buying opportunity. So you can be buying below here in these down close candles. Order block, sell side liquidity, unrealized objective in a PD array. Nothing really hasn't broken down. Like, this isn't technically a break in market structure. It's just a run on stops. Order flow is bullish. So you could be a buyer in here. Market creates a deeper run into the order block. Consolidation. Look what's consolidating, around 75% grade. And then off to the races again. And then all the way up here. So in perspective, you're seeing the buy program start down here and just a run to this. This is how you start finding consistency. It's not trying to buy it here and hold it up to here. You got to look at every price range. From here and here, there's your range to work within. From here to here, that's a range to work within. From here to here, there's 3 ranges to work in. Experience will dictate which one you work with. I took your attention here initially, and I said that I believe around Christmas time, we will be above here. And well, we were, because this is the week of Christmas. In fact, it's the day after, and we're even higher than that. So this lesson highlights the repeating phenomenon around algorithmic theory. Repeating phenomenon is not every time. Okay, it's just the majority of the time. These are the things I'm looking for. These are the things I'm looking for in price action. If I'm watching a price action move on a 1-minute chart and I'm trying to trade inside that range for the session, I will treat this low and this high at, say, for instance, how can I say it? Like, say this is the high of London, and we traded down into New York. And say this is not a daily chart, okay? Say this is like a 15-minute time frame, okay? I could work within the range from this low to this high on a 15-minute time frame, and then work with a 1-minute chart, doing everything I just showed you here with a 1-minute chart. I would grade the price swing with this framework here on a 15-minute time frame, and I'll work around all that if my bias suggests that this is a likely run to take out the London high. So it's not just applicable to 4-hour charts for long-term position trading or swing trading. It can be scaled down to micro market structure and trading 1-minute charts. And when you start studying that, and there's a plethora of opportunities for you to study using a 1-minute and 5-minute chart. All you have to do is go back and look at your session highs and session lows and think about how we were bullish or bearish during that time, and study with that context, and your charts will look entirely different to you then. They will start telling you a story that's been hidden from you all this time. But you cannot appreciate it or find it with me just talking about it. Like here, I'm giving you the way or the process to start seeing it for yourself. But you have to go in, and you go into the charts digging in. You take your pickaxe, your shovel, and you put your miner's cap on, and you get in there and you just start digging around using the things I teach you. And then something magical happens, okay? It sounds comical to the cynics, but after a period of time, and I don't know how much time, once you spend enough time doing this for you, you will start seeing things that make sense to you. And everything that I'm saying that may seem like it's a different language sometimes, or it's like, I wish he would just get to the point or say what he's trying to say. I'm saying exactly what I want to say. You just aren't where you need to be able to see what I'm saying in the chart because you haven't spent enough time digging around. You're just looking at my examples. So something will happen where it'll click. Then you'll start seeing it with a perception that you didn't have before. It doesn't mean you're going to start trading with 100% or even 90%. It just means that you're going to start seeing things in charts more clearly. And then that's another milestone. And it's very exciting when that happens, because then you start forecasting where price action moves are going to occur. Think about it. If you can grade the price swings like this, you can forecast a specific range of opportunities where breakers are more likely, turtle soup runs on stops as entries. Okay, some of you are afraid to buy sell stops. Well, when you understand this hierarchy and how it works within a range and how you can grade price swings using a draw on liquidity, okay, you're using bias, you're using algorithmic order flow, and you put all of these things together. Notice that I did not bring in commitment of traders. See that? I have not rung in interest rates. Notice that. Notice also that I have not brought in anything except for the very things I talked about here. And I still framed an entire price run and forecast exactly where these moves would potentially form. That's repeating phenomenon. That's how you know that these things are controlled. It's delivered with a program that is engineered to do things repeating over and over and over again. There's slight little nuances that you need to know, otherwise you won't pick up on it. And this stuff happens all the time, and it's been happening. Before everything went electronic, manual manipulation would take place around these levels. Men would sit around and control price. It sounds contrived. It sounds nonsense. Everybody out there is shaking their head that's been trading for a little while. They're like, there's no way it was like that. It only started when it became electronic trading. No, it's been like this forever. Forever and ever. Since they started speculating, it's always been controlled. It's just like the casino. They got to let some people win. Okay, that's a given. But the majority lose. That's the game. So once you know how they stack the deck, and when they run the table out, you can bet only when it's likely to happen. But notice I said when it's likely to happen. That's not the same as saying you're going to win because this is what's going to happen. It's just a probability thing where without these signatures in price, there's no way I could know what was going to happen. And I would fail miserably every single week with you. I would be failing every single week to be able to tell you what the market was going to have delivered in our charts. But you see the opposite of that, because I'm using the things I'm teaching you here, and I'm leaning on these things. Now, if these things were not true, if they were not algorithmic, if they were not absolutely controlling price, then I would absolutely be the luckiest person on the planet, and I don't believe in luck. So if I could not see these things, I would be failing miserably. You all would have unsubscribed. You would have said, this is it. I don't need to say anymore. This guy doesn't know what he's talking about. But the opposite is what you see here. I'm presenting the evidence to you. Now, do you need to subscribe to every little pip fluctuation is controlled and manipulated to be profitable? No. And that's what I'm trying to show you here. We're only looking for those choice little setups where everything just makes perfect sense for it to occur. We're not looking for everything in my arsenal to be speaking at the same time. We're looking at specific things that must be there. What is that? Things like I'm showing you here. If I'm not looking at a market maker buy or sell model, I'm looking at graded price swings like this. That right there is another thing I just laid heavy on you. I'm not always trading in a market maker buy model or sell model. Sometimes I'm looking at just a simple price run on a liquidity basis, and I grade that price swing like I'm showing you here. And those are the only two pillars of my trading. That's it. Why is it just those? Because that's how these markets book. That's it. And if it doesn't make sense, or I can't see it, if I can't connect with it and see, okay, this is what I'm supposed to be doing right now, I'm not doing anything. And I know why I'm not doing it. And guess what? I'm content. I'm absolutely content with not doing anything when I cannot see a market maker buy model or a market maker sell model or a one-sided price run to liquidity like what this is here. Light bulbs are going on, aren't they? This is going to be enough for this video. But I want you to just know that if this is the first time you've been introduced to this idea, it's taught deeper in the content. Okay, just trust me, it's there, and we will dig more into it in charter membership. But I hope you all had a very pleasant and warm Christmas holiday, and I will tell you that we will talk again, obviously, on Wednesday. I'll give you some more teachings, and then I'll probably have next weekend's lesson up by Friday just to make sure I have it before the end of the year. Charter members, your last two model trade plans will be up before Thursday. Promise, Scouts honor, it will be done. It's the holidays, and it's just been one of those things where I just haven't been able to sit down and do what I need to get done. But it'll be done before the end of the year, and I will have made good on my promise that the 12 trade plans will be delivered over the course of 2020. And then we go into algorithmic theory for the charter members in 2021. And that, my friends, is going to be it. If by chance you don't watch any of the recordings next week before the turn of the year, Happy New Year, be safe, and I will do my utmost and best to make sure that 2021 is an enrichment in your understanding and in your learning. Until I talk to you next time, be safe.